Hello and welcome to RockCreek Insights. For the next 20 minutes, we are going to celebrate Women's History Month. And we're going to do so by showcasing 6 talented female portfolio managers, each of whom has submitted a 3-minute video on a high conviction investment idea of theirs. These ideas range from home builders to biotech. We hope you find this insightful and interesting. Let's get started.
Hi, my name is Roselia St, the Senior Portfolio Manager at ISAR Capital Partners. Today, I would like to recommend Abiomed. Abiomed's mission statement is to save lives and recover heart muscles. The company has been around since 1981 and makes a product called the Impala. The Impala is a heart pump. The Impala is inserted into the heart via the legs, arms, or chest. When someone suffers from cardiogenic shock, which is basically when the heart freezes, the pump is inserted into the heart and does the work for the heart while the heart rests and recovers. The market opportunity for Abiomed is significant. In the US, it is only 10% penetrated, whereas in Europe, the key markets are Germany and Italy, with 20% penetration and 4% penetration in Japan. In terms of the differentiators, Abiomed is well differentiated in that it is the only FDA-approved pump for cardiogenic shock. Currently, there are no competitors. Over the past few years, the company has spent greater than $600 million in R&D and has conducted significant clinical trials to maintain their status as the standard of care in the industry, which I think is a key barrier to entry. Fundamentally, the company is very strong. The company has grown at a compounded annual growth rate of 25% in the past 16 years, a consistent 60% plus gross margin, and a very strong balance sheet with roughly $785 million in cash on the balance sheet in the most recent quarter. In terms of the growth rate going forward, the company expects to exceed $1 billion in revenue with a growth rate of 16% and an earnings growth rate of roughly 25%. In terms of the tailwind and the opportunity for the company going forward, the company continues to invest to expand into new geographies, especially in Europe and in Asia. The company also continues to focus on new indications and use for the Impala and continue to boost its pipeline with robust products in terms of both new indications and acquisitions. I think Abiomed is well positioned to maintain its market position as the only company with a cardiogenic pump on the market and will continue to differentiate itself as it finds new use and indications for the Impala pump. Thank you very much.
My name is Brittain Ezzes, and I am the Portfolio Manager for the Small Cap Value and Mid Cap Value funds at Mutual of America Capital Management. The following views are my own and not those of my firm. I believe that shares of Faro Corporation, ticker FOE, are attractive, offering 30 to 50% upside. Faro is a specialty chemical company whose materials are sold to manufacturers for use in end products or manufacturing processes and sold around the world. I believe the shares are undervalued for 3 primary reasons. The first and most interesting is the recent sale of the company's tile coatings business. This divestiture just closed in February, netting the company roughly $450 million in gross proceeds. It's particularly interesting because the earnings from the business have been removed from estimates, and yet the proceeds will not show up on the balance sheet until the March 31st quarterly report. In addition to that, Faro has historically carried higher leverage on its balance sheet than many of its specialty chemical company peers. Following the deal, the company will only have roughly 1 turn of net leverage on its balance sheet, giving it much greater flexibility and also mitigating some downside risk. Second is a potential inflection in revenue growth. Faro has not actually shown much revenue growth in the last 10 years. That's partly due to planned divestitures, but also due to lackluster demand in many of the company's end markets. This could be at an inflection point now as the world emerges from COVID, and indeed we're seeing some improvements in the automotive, electronics, and construction end markets already. The third and final reason is margin improvement. I believe Faro has the potential to earn EBITDA margins of roughly 20% or even higher compared to the 16% reported in 2020. I believe the 400 basis points gap can be closed with a few levers, including a manufacturing cost takeout program that is already underway, investments in new products that carry higher margins than the existing portfolio, and just sheer operating leverage with the return of revenue growth. Faro's shares currently trade for around $17. I believe the upside will be realized as sales do improve in 2022 if they can approach $1.1 billion and margins can close the gap only partially to 18.5% from the 16% today. Then the company should earn roughly $1.30 in free cash flow and shares should be valued in the low 20s. If the company can realize the full 20% EBITDA margins, they should be able to generate closer to $1.50 per share in free cash flow, at which point the shares should trade in the mid-20s. And beyond that, if management can find accretive ways to deploy their excess free cash flow, there should be further upside from there. Thank you.
So my name is Michelle Ross, and I'm a partner at Spera Healthcare. My stock pitch is C4, ticker CCCC, as part of a basket investment of a group of companies using a new scientific approach to treat cancer, autoimmune, and neurodegenerative diseases. Technology is called protein degradation, and we are finding ourselves in a position now with this scientific advancement similar to the early 1980s, when a technology called monoclonal antibody development revolutionized the way diseases are treated and drugs made. As you can imagine, the total addressable market is in the hundreds of billions, as this approach would allow targets that have never been available for drug development to be accessible for the first time. We all hear a lot about DNA and RNA lately. It seems as though they are a part of everyone's vocabulary now, thanks to this incredible vaccine technology that's a dramatic force in helping the pandemic. But at the core, DNA and RNA are the building blocks of this workhorse of our bodies signaling, which is the proteins. The reason we've historically focused upstream at the DNA level has been because only about 10% of all human proteins are traditionally considered targetable or druggable, given their location and structural limitations. Protein degradation is part of cell's regulatory network that ensures unnecessary proteins are removed from the cellular environment when they are no longer needed or damaged in any way. When a cell is unable to degrade abnormal or unnecessary proteins, these proteins can accumulate and form the basis of many diseases, including several malignancies and neurodegenerative disorders. Scientists are exploring how to use protein degradation to approach research in a new way, effectively leveraging the body's natural system to target and remove pathogenic proteins and maintain this homeostasis. The approach is one of our favorite themes in biotechnology right now, and our preferred way of investment is taking a basket approach, where we believe positive data in the field over the next 12 months will be reflected in the valuation of a number of companies involved. Our favorite names working on the protein degradation pathway are C4, Chimera, and Wincrest. Thank you very much.
Thank you, RockCreek, for acknowledging women wealth creators. I'm Nancy Kukacka, the founder and portfolio manager of Avalon Global Asset Management. When I started the fund 25 years ago, I aimed to build wealth and generate above market returns by investing in innovative companies that would outgrow their global peers in tech, consumer, healthcare, and the business services sectors. 2+ decades later, and with 17+% average annualized returns delivered to our clients, we've seen digitization, mobility, and the beginnings of artificial intelligence transform the economy and how we live. Today, I'm especially excited about Lennar Corp, the largest and ESG-driven home builder in the United States. Demand for housing is robust in this low rate backdrop, and the long-term supply positions suggest sustained home shortages for the foreseeable future. But the magic fairy dust that we see here centers on Lennar's adoption of technology across the continuum of building and selling homes and designing green communities outfitted with next-gen energy solutions and smart grids. Lennar's robust core fundamentals, plus the embedded value of the digital assets they own, look extremely undervalued compared to the market's current affection for comparable unicorns within its peer group. That includes Zillow, Redfin, and DocuSign, which you've all probably seen and used. We see Lennar's share price appreciating 30% over this next year as investors see the real earnings power that legacy leaders can create beyond the VC borders of Silicon Valley. We look forward to sharing more with you about Avalon Global in the future. Thank you.
Hello, my name is Jillian McIntyre, and I am founder and CIO of 221B Capital Partners. I am honored to present to the RockCreek family in celebration of Women's Month. 221B, named after Sherlock Holmes, is a New York-based global long-short equity fund that seeks to marry secular themes with bottoms-up fundamental analysis. Our contrarian nature is based on our deep research, sleuthing, if you like, along with our repeatable investment process and a team with over 50 years of investing experience. We stick to our wheelhouse, which includes technology, renewable energy, and industrial companies. We've presented at several well-known events, but we are best known for our 5M's investing philosophy, which includes management, mendacity, model, mania, valuation, and mediocrity. Today, I would love to share with you one of our long ideas, Otis, ticker OTIS. Otis is an elevator company with a market capitalization of 28 billion. Elevators may sound boring, but we would disagree. Elevators are becoming smarter with the inclusion of Internet of Things or IoT. And this is the principal driver behind its margin upside. Very high cash flow conversion of between 150 and 200% and a deepening moat over time. Otis has been a core position for me since it was spun out of UTX in March of 2020 and has yielded a 48% return, outperforming its peers such as Kone in Finland. The key things that make Otis a solid 3-year investment is as follows. Number one, excellent management. Otis is one of the few global industrial companies that is run by a female CEO, Judy Marks. She and her team, since spinning out, have consistently executed to plan. Secondly, model. Otis's business model is made up of a mix of 40% elevator installations and 60% services. Services margins are 3x new elevators, and with the inclusion of IoT, those margins will only increase over time as services become more efficient. Number 3 is mania. Since March, estimates for Otis have risen 16%, while its peers are flat. It has an entry yield of 5% and IRR of 22%. Otis is trading at a 30% discount to its peer group, which we think is highly unwarranted. And finally, mediocrity. In terms of mediocrity, Otis has become more of a consensus long, but we still think that street models are underestimating the upside. Our risk-adjusted return is based on fiscal 21 estimates is 26%, or a price target of $84. Thanks so much for listening. Bye-bye.
As background, when it comes to equity longs, I prefer to find investments poised to reward shareholders with the dual tailwinds of idiosyncratic earnings growth and PE multiple expansion arising from an increasing TAM. With that said, today I pitch Mattel. Mattel is the owner of a portfolio of scarce assets in the form of iconic, globally recognized brands such as Barbie, Hot Wheels, and Fisher-Price. Mattel did $4.5 billion of revenue in 2020 and has a market cap of $7 billion. There are 3 primary reasons why I believe Mattel is poised to double its share price midterm and has the potential to move even higher in the long run. First, the doubling of EBITDA. The drivers of this improvement are twofold: regaining top-line growth and higher incremental margin flow-through as a result of cost structure simplification. Near-term revenue opportunities come from Fisher-Price and American Girl brands, where after several years of declining revenue, turnaround efforts began to bear fruit with top-line growth in Q4. The combined revenue opportunity at these two brands is an incremental $1.5 billion, or a 30% increase versus Mattel revenue today. Increases in revenue should drop through the P&L at a higher incremental margin, as Mattel has taken out nearly $900 million of costs, positioning margins to expand from 9% today towards a prior peak of 18%. The second reason to own Mattel is improved free cash flow delivery due to Mattel's capital efficiency initiatives and debt refinancing. Following the hard work of factory consolidation and manufacturing outsourcing, annual capital expenditures on a go-forward basis should average approximately $150 million versus $300 million a few years ago. Furthermore, debt refinancing has reduced annual interest expense by $45 million. With these initiatives, Mattel may generate over $1 billion of cumulative free cash flow over the next 2 to 3 years. Should Mattel achieve our target EBITDA of $1.2 billion and see its trading multiple re-rate to the level of its peer Hasbro, we could see a $40 stock versus $20 today. This target price is without considering the third primary reason for a Mattel investment. The icing on the cake could come in the form of a successful execution of Mattel's strategy to capture the full value of its IP via the entrance to new addressable markets such as film, TV, and video games. Mattel has already signed 10 movie deals, including one with screenwriter Greta Gerwig and actor Margot Robbie for a live-action Barbie movie. On the video game front, Mattel recently launched a Hot Wheels game on Roblox and is soon to launch on Nintendo Switch. While not yet driving any revenue, we believe these initiatives could be a catalyst for further earnings growth and for a new class of investors to buy Mattel's stock as the company becomes a high-margin media story and no longer just a consumer products company.
And that concludes this edition of RockCreek Insights. On behalf of the managers, we'd like to thank RockCreek for the opportunity to present. We'd also like to laud and applaud RockCreek for their commitment to diversity when building world-class portfolios on behalf of their clientele. I'd like to thank the managers for so graciously sharing their insights and knowledge with us, and of course, the audience for the generosity of your time. We hope that you have found this an impactful way to celebrate the contribution of women to asset management during Women's History Month. Thank you and goodbye.